Hello, everybody. Adam Bergman here, tax attorney and founder of IRA Financial. And on today's video, talking about post April 18th tax planning tips. So, I'm not sure how you feel, but April 18th or April 15th in most years is, one of the most stressful days for me. Yes, I do earn a salary and generally have taxes taken out, but every year I seem to get a call from my accountant saying, hey, guess what? Bad news. You owe more tax. And the next thing I say is, what do you mean? I'm a tax attorney. I can plan for this. What are you talking about? And then the next thing he always says is, hey, Adam, you do Roth contributions in your 401k. So you lost a $20,000 deduction there. And plus you have income in these instances and you weren't able to benefit in deductions on these cases, and this is what you owe. And he generally gives me like 3 days to write a check, and it's never fun. So what I wanted to do is say, hey, for anyone out there that's maybe filed an extension on April 18th and now has until October to file a final tax return, you have some options. There are things you can do to minimize your tax liability. And I'm going to tell you what they are. And the first thing is, if you're self-employed, you got a huge opportunity here, huge advantage. Why? There's something called a solo 401k. The solo 401k is the most robust plan for the self-employed. What that means is if you're self-employed, you have a business, it could be any business. You could be a math tutor, you could be selling widgets online. Just needs to be a business regularly carried out for the potential to earn income. Okay, it doesn't have to be Netflix or Tesla. It can be a business. And the business cannot have any full-time employees other than owners and their spouses. You can have a 1099 contractor, but no W-2 employees that are not the owners or their spouses. So if you satisfy those two requirements, you can then set up a solo 401k. And thanks to the Secure Act 1.0, which was passed in December 2019, you can now set up a solo 401k in 2022 for the 2021 taxable year. That means you still have a chance to generate contributions up to $58,000 or $64,500, all tax deductible. Here's the wrinkle. When you set up a solo K, generally, if you set one up in 2022, for the 2021 taxable year, you'd have the ability to do employee deferrals and profit sharing contributions. But because you're setting up the solo K in 2022 for the 2021 taxable year, all you can do is set up profit sharing contributions. So you don't get the employee deferral, which in 2021 was $20,500 or, I should say $18,500 or $24,500. Okay, so you are limited. In 2022, it's now $20,500 or $27,000, but in 2021 it was the 19.5 or the 26. So from the employee deferral standpoint, you want to make sure that if you are focused on getting the employee deferrals, you're going to have to set up the plan in the year you want the contributions. But you still have the opportunity to make profit sharing contributions for 2021 in the 2022 taxable year, which is really exciting. Okay, so that means that you can do the profit sharing contributions and go all the way up to 58 or 64K. Okay, so when I mentioned the amounts, 58, 64, 5 for 2022. So example, you make 100K, you're self-employed. Schedule C, single member LLC, you can do 20% of 100, giving you $20,000. That is a $20,000 tax deduction. Okay, that's pretty big stuff. Okay, so again, 25% if you're a W-2, 25,000 based off our example, tax deduction. That means if you made 100K, 25,000 if you're W-2, S Corp, C Corp, goes into your plan instead of the IRS, and now you owe tax on 75 instead of 100, plus the 25,000 now rests in a retirement account, and you can generate tax deferred income. So just want to clarify the employee deferrals for 2021, they don't apply. And for 2021, they're 19.5 or 26,000. Okay, so those do not apply if you set up the plan in 2022 for the 21 taxable year. But you can still do employer contributions up to 58K or 64.5. So if you make 200K in 21, you're self-employed, you don't have a solo K, you can do 20% of 20, that's 40,000 bucks tax deduction. That money then goes into a retirement account. You can invest it, stocks, alternative assets, whatever you want, but better yet, the funds are not subject to tax and you get the benefit of deferral and you reduce your taxable income. So it's all about generating tax deferred and tax deductions, okay? And the solo K will do it. Even though we are in 2022, you can still benefit for 2021. Isn't that incredible? And what about the SEP? SEP IRA, same rules. You can do a profit sharing contribution. There's no employee deferrals in SEP, so you're good either way. And you can set up the SEP up until you file your return in October and do the 58. Now, if you're over 50, the SEP IRA is no catch-up, right? The solo K has the catch-up that lets you go 58 to 64.5. If you're over 50, SEP IRA does not have it. So you want to go solo, especially if you're over 50. But even if you're under 50, you want to go solo because the solo K also has a loan feature, lets you borrow 50,000 or 50% of your account value, whatever's less. Use that for any purpose. You can do Roth contributions for 2022 in the employee deferral world. Right? The solo is going to help you for 21, just like the SEP, but the solo also has a loan feature. Okay, you can do alternative assets and use leverage without triggering a tax called UBTI or unrelated business taxable income, which would apply in an IRA. But for the 2022 taxable year, you can now do employee deferrals, which lets you go 20,500 or 27,000 if you're over 50, dollar for dollar. So the plan's going to help you in 21. It's also going to help you in 22 and beyond. So it's a win, a big, big win, because you're able to get those deductions for 21 and then reap the benefits going forward, hopefully until you have your business. SEP IRA is only a profit sharing plan. So it's only going to give you that 20 or 25% in 21 and 2022 and beyond. So that's why I've written 2 books on the solo. It's going to beat the SEP IRA all the time. Now, if you have employees, you can still set up a 401k. You're only going to be able to get profit sharing contributions for you and your employees for 21, but hey, you'll have a plan for 2022 and beyond, and you can get a $500 credit plus for setting up the plan. What else is still good for 2022? You can still do in 2022 and 2021. Well, not much. Okay, the retirement account contributions and the solo and the SEP is really the ultimate tax benefit that you still can do until you file your return. Okay, so that's pretty cool. What else can you do in 2022 for 2022? Well, a lot. The big thing a lot of people don't realize is there's something called accelerated depreciation on certain machinery or equipment. And this is thanks to the 2017 Tax Cuts Job Act that will let you, if you purchase equipment or certain material in a business, you can deduct it up to 100% in 2022. Okay, so 23, that's going away. So if there's some machinery or equipment for your business you want to buy, don't put it off, buy it in 2022 because you'll get that deduction. 100% accelerated depreciation deduction. Deductions are huge. Tax lawyers, we love deductions and credits. Credits are better than deductions. The credits reduce your taxable income dollar for dollar. Deductions reduce the income subject to taxation dollar for dollar. So credits beat deductions, but deductions are still super good. And trust me, I wish I had more deductions this year, okay? Because that reduces the amount you have to write a check to the IRS. So 401ks, solo Ks is the ultimate way that you can still get tax deferred deductions, tax deferred income, and tax deductible deductions for 2021, even though we're sitting right now after April 18th, 2022. But what else should you do 2022? Accelerated depreciation for purchasing machinery, equipment. This is the year to do it. Also Roth conversions, right? The downside of a crappy stock market and crappy crypto market is that it's a good opportunity to do conversions. So for example, Netflix, right? Netflix dropped, the stock's been tanking the last week. They lost subscribers. It's down 30, 40% for the year. If you still believe in Netflix, because it turns out a lot of the subscribers they lost are in Russia, where they stopped service. They lost 700,000 subscribers in Russia. So when you look at the $200,000 net they lost, not so bad. They did lose some subscribers in the US, but They also gain some in other countries. So if you think, hey, this is a good opportunity to take advantage of the depressed value of Netflix and you own it in an IRA, maybe you want to convert it to Roth. Pay tax on today's value, as long as you hold the Roth 5 years and you're over 59.5, it's all tax-free when you pull it out. So opportunities present themselves. You just got to know. And that's what I'm trying to do here. Educate all of you, use some of my tax background. I've master's in taxation. I worked as a tax lawyer for 9 years. I've been in the self-directed retirement world 12 plus years. This is what I do. This is my passion, and I'm happy to share it with you. So there are still a bunch of stuff you can do for 21. Like I said, the solo, the SEP, and there's a lot of stuff you can do in 2022 to help you out. Yes, I will do future videos and podcasts as we get into the fourth quarter about last minute tax planning tips for the 2022 taxable year. But as of April 2022, there's still a lot you can do, right? There's charitable contributions. There's contributing appreciated stock to charities. There is obviously conversions you can do. There's also accelerated depreciation. Now, what are some other things you need to know about some changes that happen in 2022 that can impact you? One biggie is if you use a payment app like Cash App or Venmo, they're going to start reporting transactions in the aggregate of above $600. So, hey, maybe you've done some freelancing work or like software editing or painting or tutoring or improvements, and you got paid by Venmo or Cash App. In the past, the threshold for reporting was much higher. Now it's just $600. So that means once you're over $600, Cash App or Venmo will 1099 you on a 1099K. That means the IRS are going to know about this. That means if you're not reporting it on a 1040, they're going to find out. So this is a warning. Okay, this is in effect this year, beginning January 1, 2022. So these 1099Ks are going to go out beginning of 23. So if you're receiving in the aggregate over $600 from various sources, there's something you can do. Again, goes back to the solo K or the SEP. Set up a solo K. Let's say you have $5,000 from paint jobs. You do improvements for your friends, neighbors, or random people. It's a side gig. You do something else, but you collect money on Cash App or Venmo. Now they're going to be looking for it. In the past, the IRS may have not known about it. Now they will based off the 1099K. So you may be thinking, damn, I'm going to have to pay ordinary income on that. Hey, set up a solo K. I can reduce that amount where you just have to pay Social Security and FICA, maybe about 12.5%. And all that other money will now go into a 401k that you can invest in stocks, cryptos, real estate, whatever you want, and generate tax deferred income and take the money out of Uncle Sam's hands and then use those funds to invest. So not the end of the world. You can still do your gigs. You can still generate money on Cash App or Venmo, but you can reduce the amount you have to pay based off that 1099 by dumping that money in the solo K, just paying Social Security and FICA, and have the money work for you tax deferred by investing it, and they get that deduction, so you don't have to pay tax on the full amount on your 1040. Now, Zelle. I didn't mention Zelle. Zelle claims they're exempted because they claim they are just connecting you directly from your bank, and they facilitate messaging between financial institutions, and they actually are not a payment network. So we'll see. They claim they're exempted from this, so that may move people to Zelle, but we'll see what the IRS thinks about this. But right now, if you Venmo or Cash or other payment apps, you're going to be getting 1099Ks if you have transactions over $600 for the year. And that's for payments for goods and services. Okay, so just an FYI. Like my kids use a basketball coach. He helps train kids in the neighborhood. He probably generates 10 to 15 grand a year. I talked to him about this a few weeks ago, and he's like, yeah, I'm setting up a solo K for sure. Because I'll contribute those funds into the plan. I'll pay my Social Security and FICA. He's also a sport coach for a school, so he's got his own gig. He has a 401k, but I told him, hey, even if you can you'll be able to go dollar for dollar because you're not maxing out at school. If you make 10, 15 grand, you should be able to dump most of that into a solo K. Just pay your Social Security and FICA. Yeah, it sucks, I know, but it's something you got to do. And the remaining amount will be able to be contributed to a plan. Then you can buy stocks or cryptos or do hard money loans to friends or other investments. That money grows without tax, and you'll get a tax deduction for the amount that you would have otherwise had to pay tax on your 1040. So something to be aware of. Just some other things that you should know. RMD age has moved up to 72. if you want to do IRA contributions, there's no age limits anymore. There used to be a 70.5. I've talked about this. Secure Act 2.0 has passed the House. It's going to the Senate. Some pretty cool stuff in it. It's been full bipartisan support, which is nice to see. We all remember the Build Back Better Act, which the president tried to pass last year, which Senator Manchin essentially blocked. I think the lesson from that is you need consensus. You can't just push legislation down the other throats of the other members of the House without some type of working arrangement. Retirement system generally works. We saw it with Secure Act 1.0. Now we see it with Secure Act 2.0. There is generally collaboration, consensus. Both parties understand the retirement system works for all Americans. Why? Based off the power of deferral, based off mathematics, generates deductions, your money grows without tax. Everyone wants their constituents to have money at retirement. So there's generally really good consensus. And we saw it with Secure Act 1.0 and the Secure Act 2.0. And it's a good lesson from Build Back Better. If you haven't seen any of my videos or listened to my podcast on 2.0, there's some cool stuff. They want to increase the RMD age from 72 to 75 over the next 10 years. If you're between the age of 62 and 64, instead of just giving you $1,000 catch up, they want to be able to give you up to $10,000, over time. So that's pretty cool. It will hopefully help people save. I wish they expanded that from maybe 62 or 60 to 75, but they feel like that's the age, the 63 years, 62, 63, 64 before 65 age of retirement. They want to give you a nice $10,000 catch up. They're going to allow Roth contributions for simple and SEPs. The Senate version wants to actually allow you, which I've been pushing for years, roll over Roth IRAs to Roth 401ks. I'm hopeful that's going to be in a bill that the president will sign towards the end of the year. Again, this is going to happen. Secure 2.0 is going to happen. Why? It makes sense. Dems, Republicans, they want to give all of us more options, a greater ability to save in a retirement system. So it makes total sense. And again, I think if the president and the Democrats worked closer with the Republicans towards the Build Back Better, when that was being worked on towards the fall last year, I think it probably could have passed, honestly, if they didn't push too hard and kind of were more reasonable and a little bit less aggressive. There could have been the Ways and Means Committee probably could have worked closer, and I think you would have seen whether it's Manchin or Sinema accept it. But I think it was just very, very harsh and aggressive, and that's why it didn't pass. So it's a good lesson for all of us. You got to build, you got to work with your other counterparts. You can't just push rules and legislation down the throat of the other side. And it works with business too. There's got to be consensus, even if you're competing or you're working with team. You want to build a relationship, build consensus, and I think ultimately that's how you get to the best outcome. So, in sum, you're watching this, you're like, oh man, I filed an extension, Adam. It's 2022. Can you really help me? If you don't have a solo K, set one up. Okay, especially if you're self-employed, you need one. If you have a solo K, then there's still time to make contributions. Okay, this is important. If you have a solo K set up in 21 and you're not a W-2, you're not a C or an S corp, you can still do employee deferrals. Remember, I talked about the 19,000 or 26 5. You can still do that in 22 for the 21 taxable year. Okay, so sorry, I keep mixing these numbers up because we're in 2022. It's the 19.5 or the 26. So if you're under 50, you can do 19.5 for 2021, 26,000 if you're over 50 for 2021. If you're a W-2 and you have a plan set up, you technically can't make employee deferrals. You can only do the profit sharing of 25%. Well, if you are self-employed, single member LLC, Schedule C, and you have a solo case set up in 21 or before, and it's 2022, even if you file an extension, you can still do the employee deferrals with the 19.5 and the 26, plus the profit sharing contribution of the 20 or 25%, up to the aggregate amount of 58,000 or 64,500. Now, whereas if you're setting up the solo K for the first time in 2022, you cannot do the employee deferrals of the 19.5 or the 26 all you can do is the profit sharing of the 20 or 25%, but it's still real money, right? Even if, let's say you make 60K, 20% is still 12K deduction. That matters. If you are a W-2, 60,000 times 25%, that matters. That's deduction. That's real deductions that's going to reduce your taxable income. That's going to mean you owe less money to the IRS. So every dollar counts. You can ask my accountant. Every dollar counts in terms of generating deductions to reduce your taxable income. The solo, the SEP, those are the best ways to do it. If you're thinking, hey, I did what I could in 21, what do I need to think about 2022? Conversions on depreciated assets. If you're buying equipment, machinery for your business, this is the year to do it. Do not wait till 2023 because you'll lose the 100% accelerated depreciation. So think about that. And then also, if you use Cash Apps or Venmo, remember, if you get more than $600 from selling goods or services, IRS will get a 1099-K. They will know about this. So that may be another reason to go solo, set up a solo and just pretty much dump most of that money into a retirement plan to reduce your taxable income. But for the Social Security and FICA, you'll be able to do that. Plus, you'll then have all that money to invest in stocks or alts. So kind of a win-win. Otherwise, stay tuned. There'll be more videos and podcasts in after summer 2022 for tax planning tips, last-minute tax planning tips for the 2022 taxable year. But again, a lot of it's centered on the retirement system. Why? The retirement system gives you the greatest amount of depreciation, well, the greatest amount of deductions available, whether it's the Solo K, which will let you go 60,500 or 67,000 if you're over 50, or it's the SEP, just the 60,500. It's generally the biggest source of deduction. However, the accelerated depreciation deduction opportunity for 2022 will go away in 23. So that could be the big winner going forward in the 2022 taxable year. Also, don't forget charitable contributions will generate deductions, especially of appreciated assets like stocks or real estate and cryptos. That could be a nice way to get the deduction, and then the charities can use the asset and sell them without tax. So there you go. Hope you guys enjoyed today's video. I know I did. I try to do YouTube lives every Wednesday, so don't forget to check it out. Usually drops noon every Wednesday. Can't promise it's every week, but I try. Also, subscribe to this channel if you haven't already. Generally drop about 5 videos and 3 podcasts. So tons and tons and tons of really, really, really good content that I work really hard on with my team to prepare and provide to you for free. So check it out. Hard to believe it's free. Yeah, it is. And you can hopefully learn. If you have questions, let us know. We're here and we'd love to help. So thanks again for watching. Have a great day and talk to everyone again soon.